Hey, good morning, everybody. It's Hammer. Today is Tuesday, May 27th, 2025. I, of course, am Hammer, back from vacation. Thank you again to Mr. Ron Siegel for guest hosting while I was away. Certainly appreciate him doing that. Hope y'all had a good time. Sorry the texts didn't go out properly. I had them on automation. Doesn't look like that worked before I left. So unfortunately, you may not have gotten text reminders, and I'm sorry about that. But anyway, good morning, y'all. Thank you for joining me. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Listen to Ron look at him put Pacific on there. We don't need no damn Pacific. You got to join me 9:30 a.m. Eastern time. You know what time it is in your time zone. Good morning, y'all. If you are here live, say good morning. And again, thank you for joining me. If you are on the replay, please go ahead and give me a hashtag replay in the comments. Let me know that you were here. And if you would like a reminder, again, I apologize if those did not go out properly while I was away, but you can sign up for text reminders at hmmr.io/reminder or use this cool QR code. If you're on your phone, take a screenshot. You can go back into your photos and actually use the QR codes, which I think is wicked cool. And it's awesome that they've built that technology out. So if you're here this morning, say good morning. Let's go ahead and say hi to the live folks here this morning. And welcome. Let's see who we got here. We've got Allison Foy. Good morning, Chef Greg. Good to see you. Robert Bashirs. Yes, dude, I do have a suntan. But generally that just means more freckles for me. There you go. There's some freckles. So, but I used sunblock. You of all people know the importance of that. So I did use sunblock while we were riding. But yeah, I do have a suntan. I do have the raccoon eyes. But it's funny, the phone's being very generous to me, this camera. Yeah, I guess I don't look all too tan, but oh well. Good morning again, Mr. Ron Siegel, and thank you, sir. Mr. Ron Siegel says today is National Grape Day, although he prefers his distilled, which is funny. I get that. To me, it's all spoiled grape juice. But let's see. Megan Bissell, good morning. Got Amy Blaser here. Good to see you. Mike Brown, Mallory Fotiadis. Thank you so much for the welcome backs. Tim Klyla, good to see you. Megan Bissell, obviously Robert, good to see you too, sir. Taylor Henry, Deb Dickinson, great to have all of you here. All right. Well, other than National Grape Day, what's your favorite kind of grape, by the way? We'll make that the question of the day since I am still, you'd never know I was up early trying to cancel. Here we go. Hold on a minute. Let me get it down here. You would never know that I was up early. What is your favorite kind of grape? Green, purple, cotton candy, etc. What is I forgot, what is there's a name of it, not Concord. Not Concord grapes. There's a grape that we like. Maybe someone else will say it. Thank you, Tom Stafford. Appreciate you. I am excited to be back. You shared the photo, a photo of the Hammer boat in Newport Beach, California. That's funny. Yeah, no, we got 1,600 miles in, so the Cabernet here killing me. All right, good morning, y'all. So let me get to the good stuff here. Hold on, let me move off the captions. Sorry, it's a morning already, so got to get to the chat, and we can hide that message. There we go. All right, good morning, Greta and Randy Tico. Giddy up, sir. All right, y'all, let me go ahead and share the screen. I've been catching up this morning. I don't know what y'all did to rates and pricing and everything last week. Why'd y'all let rates go up while I was gone? Who was in charge of that? Whose idea was that? Taking a look here, Mortgage News Daily, going from the 16th to the 23rd, y'all let rates go up about 1/8 of a point, it looks like. So they did get a little bit better towards the end of the week. We're a little bit higher middle of the week. I know that we saw some stuff going on with the different things, the PMI, anyway, some stuff going on last week. So where are we at this morning? Taking a look here, mortgage-backed securities are up 22 basis points on the day. Don't get overly excited. Part of that has to do with some stuff going on over in Japan. Let me pull this over on the screen here and we'll share this. So basically, a rally in Japanese bonds spilled over to U.S. Treasuries as signs that authorities in Tokyo may look to reestablish stability after a tumultuous period, blah, blah, blah. If we want to know what that means in actual, like human speak, basically, if we take a look at this article here and what that means, let's see, basically Japan, cut back on selling its own bonds is what you're seeing happen here. They've been buying bonds all over the place for a long time, but they sell a lot of their own bonds, and now they're cutting back on that. So that means markets, big investors, especially in Asia, they might look elsewhere, like U.S. Treasuries, which has helped push bond prices this morning and help see some recovery. But that could be very short-lived, especially with the idea that Trump will pass the big bloated bill, the one big bloated bill, as I lovingly call it, the tax bill. That went through the House last week, it looks like, but still got to go through the Senate. We'll see. He pushes his stuff, man. He gets it through. So I have a feeling we will be seeing that big bloated bill sometime soon. The idea being that that's going to cause more debt issuance in order to pay for all that. It's not free to pay for all that stuff. So that's the concern there, and that's why expectations are that you're seeing Treasury yields that are going up, because it's expected that we're going to have to borrow more, especially on that longer term, 10-year, 30-year yield. So right now you're seeing treasuries, short-term treasuries, that are doing better than the longer-term treasuries because of that. So, but right now this morning, we're up 22 basis points. Basically, when it comes to the lock advice, I would absolutely still, let me put this up on the screen and we'll throw it out there. I'd be locking anything closing less than 30 days and longer if risk averse and willing to pay the premium. So the current trend, we've got a couple things going on here. And again, sorry, I'm just getting back in the groove this morning. So here's the current trend. I'd be locking anything that's closing in the next 2 weeks by far. Next week, we're going to get the labor market data. You're going to get the jobs data. That could come in a little bit weak, but is it going to be enough to see rates improve? And the bigger question too is, will rates move higher by the time that if we did see any improvement? And the answer is probably yes. You can see, I'll move this a little bit higher so that it's above the screen. You can see, we are trending from the beginning of May. We're this last month, mortgage-backed securities were 99.70. And then they, 99.73, and they've just continued to drop down. 98.55, that's 120 basis points that you've seen move in this month. And when you look at Mortgage News Daily as a reference point, and you look at where rates were at, we were at 6.81. We'll call it 6 7/8, and now you're above 7. You're back above 7. So we are seeing rates trend higher, creep higher. It's what we've been expecting for, before I left on vacation. It was kind of what we were expecting to see. More talk this morning about some of the tariffs. I guess the next thing is the European Union seeking to accelerate trade talks after winning a delay until July 9th for President Donald Trump's threatened 50% tariffs. Stocks rallied globally. We are seeing somewhat of a relationship again, where when stocks rally, bonds are losing ground. At least longer-term bonds are losing a little bit ground. Surge in long-term bond yields this month, threatening to upend a classic investment strategy. This is an interesting quick take on things. The 60-40 stock bond portfolio rule, a classic investment rule, right? Classic investment strategy, 60-40 stocks to bonds, just as it makes a comeback from a long stretch of underperformance. The U.S. gauge of the 60-40 mode returned some 1.6% this year through mid-May, besting the S&P index's return in the period with lower volatility. Key part of the revival has been the return of the traditional inverse relationship between stocks and bonds. Now, this is an interesting one, right? Remember, for decades, stocks would go up, bonds would come down. Stocks would go down, bonds would go up. But that is what we'll call the traditional inverse relationship. Now, that has kind of, over the last few years, though, that has changed quite a bit as investors weren't seeking safe havens. And when they would sell off, they would put more money into cash. You were seeing bonds also, as stocks improved, bond holdings also improved to maintain that diversity in portfolios. So, but a key part of the revival has been the return of the traditional inverse relationship, meaning bonds tend to fall when stocks rise and vice versa. But as the 30-year Treasury bonds have tumbled this month, sending yields above 5%, stocks have been pulled lower as well. So we're seeing them both move here. Investors perceive more risk in long-term treasuries because of the spiraling U.S. debt and deficits. So all of that, investors perceive more risk in long-term treasuries. That's the key right here. That's the problem. Because of spiraling U.S. debt and deficits posing a challenge, longer-term treasuries behaving like risk assets, not like the typical kind of defensive safe havens, basically, is what he's saying here. For bond pros, the message is clear. Stick to shorter-term treasuries, and the 10-year is not considered a short-term treasury if you're looking to balance the risk of stocks with a cushion of safer, steady income. So that's the 2-year, the 5-year, maybe even the 7-year. Ron says, Trump time, you missed it. Trump said he would impose 50% tariffs on the EU and then change course all while I was gone. Yeah, I hadn't had a chance to really catch on to that yet. I was wondering where those 50% tariffs came from. I saw him suggest that. But exactly, we know that there's that volatility and that markets are used to that volatility, and it's what we've grown used to. So the week ahead, let's kind of go into that, and then we'll wrap it up for today. The Fed's preferred inflation gauge on Friday, that's the PCE, is forecast to show that price pressures remain contained, though policymakers are likely to suggest interest rates are on hold until better understanding the coming impact of U.S. trade policy. Now, we'll get the Fed meeting minutes tomorrow from the Fed's last meeting. That should give some insight into how the Fed is kind of reading into what's going on. But remember, the Fed's last meeting, the press conference, I think Powell used the word uncertainty in some form or another, like, I don't know, was it 17 times? It was some ridiculous number of times that I remember. And that's going to be the mainstay that we keep hearing is the focus there. When you look at what the Fed's expectations are for rate cuts, what markets expect the Fed to do for rate cuts this year, the expectation of a cut in June, 95% probability there would be no cut in June. Remember that a month ago, look at how that was, so much different. A month ago, it was a 60% belief that we would see a rate cut by June. Markets keep, coming up with this idea that the economy is slowing, yet it gets crazier and crazier. Here's a quick summary about this here. Tariffs are messing with the economy again. Businesses trying to pass those higher costs to consumers. Oh, you guys can't see it. Let me pull it over. It's starting to show up in price data. Manufacturing prices jumped to levels we haven't seen since major crises like the 2008 oil spike and the 2021 supply chain chaos. So you're seeing manufacturing prices starting to go up because it's reflecting the tariffs that they paid. The tariffs are bouncing around like crazy. And could you imagine paying a tariff for goods coming in from China to the tune of hundreds of thousands of dollars for a week or two later, them to be pushed off 90 days. That's why so many shipments were waiting and why retailers were holding off and selling what was on their shelves before replenishing and seeing where it went. Services also been holding out, now raising prices too. It's a big red flag because it means inflation may be creeping back in ways that aren't so transitory. Companies hoarding inventory like it's 2020 toilet paper all over again. They're stocking up now before more tariffs hit in July. So we're seeing a lot of fluctuations. We saw a lot of early buying before the tariffs. Then we saw, using up all that inventory. Then there's more hoarding going on again, but that's not going to last forever. And when it stops, we're going to see a lot of economic slowdown, and that's a problem. Orders are up, but mostly because of the hoarding. Once that levels off, we could be in for a slowdown. Hiring is slowing in both manufacturing and services. That's only happened a handful of times since 2009, and when it did, the job market got hit hard. Now, if this does happen, this is a bit of a forecasting tool here. If it does happen, that's where you would see expectations that the Fed would actually start cutting rates. The problem is, if we see inflation at the same time, it's going to put the Fed into a stagflation scenario, and that's the concern. So exports are tanking. Demand for U.S. goods and services abroad is falling fast. Foreign tourists are skipping visits. Even Americans are trimming travel plans. Airlines are feeling the pain. Let them feel it. Bottom line, the economy is wobbling. Tariffs are pushing prices up. Demand is getting weird. Hiring is cooling. Exports are in a nosedive. GDP growth is barely staying above water and can slip underwater again soon. That would be the recession. But again, we see this, it vacillates. We back and forth, back and forth, back and forth. We get one set of economic data that goes in that direction, and then something else changes and we don't see that at all. So back to expectations of Fed rate cuts. By December, expectation of 2 cuts to 40%. Expectations will only see 1 cut at 27%. And on the flip side, expectations that we'll see 3 cuts at about 25%, right? So, it's a very different picture than we had just a little while ago. One that's not good for rates and pricing, not good for 10-year treasury yield, not good for any of this. So that's why the expectation would be to go ahead and wrap things up kind of where we're at. So let's go back to that question. Thank you, Candido. Good to be back, my friend. Thanks, Mike Morano. Good to be back. And yes, I did enjoy my trip. So let's talk. What is your favorite kind of grape? Do y'all even eat grapes as adults? I do. They've gotten expensive, though. Grapes are super sweet now. Have you noticed that? Muscadine. That's what I was thinking. Muscadine grapes. They remind me of the ones from when I was a kid. I do like muscadine grapes. We've genetically modified them so much now. They don't have seeds in them. We have seedless grapes, right? That's kind of creepy. They're sweeter than they used to be. They probably have a lot more sugar and fruit. It's a very different world. It's why what we're at. Yeah, nostalgia, muscadine. Yeah, muscadine grapes. They taste like wild grapes from when I was a kid. We used to eat grapes from grapevines, like outside, wild grapes, and they must have been muscadine because when my wife bought muscadine grapes, and I'm like, oh my goodness, that's them. That's the taste. So anyway, it's good to be back, y'all. Still getting settled in, figuring out which way is up, catching up on what happened last week while I was away. I really didn't go anywhere near my phone. I had my phone on Do Not Disturb. I didn't look at Bloomberg or the Wall Street Journal. Basically about 10 days of being totally unplugged. It was fantastic. And not gonna lie, I could get used to it. But I did miss y'all, and I'm glad to be back. So much, so excited to have all of you back as well. Mallory, yeah, your grandparents had them all over the yard, right? They were just wild grapes, outdoor grapes. They were awesome. Hello, Alan Christian. Good to see you, sir. But anyone else eat grapes? Let me know in the comments. Otherwise, we'll see you tomorrow. Take care, everybody, and have a fantastic day. Bye-bye. And Ron, thanks again for covering for me, my man. We'll talk soon.